Have you heard the doom and gloom that is going on in the commercial real estate sector? And are you wondering what this means to you as an investor? If so, this is going to be the episode of Purpose-Driven Passive Profits for you. Today, we're jumping into statistics that were just released on what is happening in the commercial real estate market. And these are leading indicators showing us where the market is going. And we're going to get into what that actually means.
Hey, accredited investor, I'm so pumped to tell you about this brick, beautiful property that we just got. It's 166 units, solid brick building, almost 100% occupied. There's 2 vacancies right now out of 166 units. The only reason we got this is because the sellers took out one of those crazy loans 2 years ago and their loan is expiring. Otherwise, they would have been able to keep this building for the long haul, but we're stepping in at the perfect time to swoop up and grab this building. It's presently rented 15% below market rate rents. I have the comps inside the actual property to prove that too. All you have to do to learn more is go to homeinvest.com and click on one of the invest buttons, or you can look down in the description of this podcast wherever you're seeing it, and you can see the link in the podcast description. Now, always consult with a tax advisor, a financial planner, or an attorney before making investment decisions. Having said all that, all you have to do to learn more is go to homeinvest.com or click on the link down in the description below. Thanks, and looking forward to partnering with you.
If you're new to the show, the gentleman sitting across from me is Nate Armstrong. He is the founder and CEO of Home Invest, an Inc. 500 company focused on real estate investments. My name is Steve Warner. I'm your Chief Investment Officer, and we are here to give you the tools to be great stewards of the time, energy, and money that God has given you. We're a Christian-based company, and we believe in stewardship, Matthew 25. So we're going to jump into it. Nate, this report that just came out, it is showing banks are setting aside record amounts of money for charge-offs right now because commercial real estate is starting to lose its footing. A lot of late payments. The numbers that I'm looking at here, I mean, this one says they set aside 134 million. Morgan Stanley set aside just this quarter for losses. What's causing this to happen?
Yeah. And so first, I think we should draw a distinction between which asset class, because commercial is a big umbrella. So commercial, when you say commercial, it's anything that's more than 4 units could be implied as commercial, or businesses or industrial. And there's a couple that are actually hurting the most. We're not talking about multifamily real estate here. We're not talking about duplexes, single family houses here. We're specifically talking about office space and retail space. As we all know, since COVID-19, the landscape for offices has changed 110%. There's no longer a mass migration of moving into office space. Businesses are still cutting leases, moving people out of office space. Zoom has become worth more per share than most office buildings around the country. So we're talking about office, and then we're talking about retail. Retail has also been driven more to online sales. And with that, it's impacting what owners of these properties are getting in rent. So how does it translate to all these banks taking these massive losses? Well, the reason that Bank of America is suggesting right now that literally they've got defaults on 4.27 billion worth of these, they call them CRE loans, commercial real estate loans. The reason that they're doing that, and the reason that you mentioned earlier, another bank that's doing it, is because when they issued these loans, they probably were shorter term loans. You don't get a 30-year fixed mortgage on a piece of commercial real estate. In fact, most of the time people take out 2-year bridge loans. Sometimes they get up to 5 years. Regardless of when they took it, they probably took it at a lower interest rate than it is today. And now today, when they have to go in and refinance it at the end of their period, that 2-year or 5-year mark, the bank is looking at their piece of real estate and they're saying, well, hold on a second here. When we gave you the loan, you had more people renting from you. Now you have bigger vacancy. And by the way, rates have more than doubled. How do you plan to pay the monthly payment? And so the bank is basically saying, I'm so sorry, but I can't refinance your property. You're not in a position, healthy financial wise, to refinance the property. And so those are the loans that are heading back to the bank. Those are the defaults that are happening right now.
I mean, we talked about this on the last podcast, like this wall of loans that are coming due that are these bridge loans. But what is going to happen? I mean, right now I'm looking at this and it's saying, okay, first quarter of this year, it was $17 million that the banks had set aside for losses. Third quarter was 79 million. Fourth quarter, they're aiming for 93 million. That's almost 5x in 1 year. Like, we're seeing like this big tipping point, but what is this going to do to banks? Like, are we going to see more banks go under? What do you think the banks are going to end up doing with these places?
Yeah, the small banks are going to take a big hit. So small banks, we're talking about like your local credit unions all the way up to the regional banks, as opposed to, JP Morgan, Bank of America, Wells Fargo. The bigger banks, they're more diversified. Their entire portfolio is not vested in commercial real estate. So the small banks right now, they have 4.4 times more commercial real estate than the big guys. So that means that the small banks, in the end, they're the ones that are going to take the biggest hits. And what will it do to them? Well, depending on the size of the bank, if they can't absorb that hit, if what happens if their loan out there is, let's just say it's a $3 million loan, if they can only sell that asset after foreclosing on it for 2 million, and they take a 1/3 loss, $1 million, what happens is that is a bad debt, a non-performing loan. It's an NPL, non-performing loan, that goes on their books, and regulators watch them. The FDIC watches them. And if they have too many of those non-performing loans and they've got a lot of bad finances on their debt, they could literally be shut down. What happened during the 2008 housing crisis, a lot of banks went under. And when they went under, what had happened is that the FDIC comes in, they audit their books, and they say, hey, you've got too many non-performing loans. We're going to force you to sell to a bigger bank. And then they force the sale. Steve, you might even remember, in all of our folks here that are listening right now, you might remember seeing a bank change its name in the middle of the last downturn, 2008 to 2012. If you remember seeing a bank magically change its name, kind of feeling like it was overnight, it was because the FDIC more than likely came in and forced the sale.
Interesting. I did not know that. I learned something new. I always learn stuff when I talk to you, Nate. So
Yeah,
I mean, so if this happens with the banks, what does this mean for somebody who is looking for a good place to park money, an investor that's looking for a passive investment? Should they stay out of commercial real estate? Should they be looking for something specific? And what is this going to mean long-term for syndicators? Should people sit on the sidelines right now and wait for some of these buildings to come onto the market?
Yeah. If you are an office operator or you know a lot about it, office space or retail, I think some of the best deals of your lifetime are about to hit the market. And so if you know how to operate that, if you're a passive investor who's never done it before, I do not recommend entering the game of offices and retail space in the middle of a downturn. It wouldn't be a good idea for you. The asset classes that are going to do well still are housing. Every single time we go through a cycle like this, residential housing does well. Why? Well, when there's economic pain out there, financial pain, people usually downsize their housing. And where do they downsize to? They downsize to apartments. They become renters. And so therefore, the multifamily real estate sector will do very, very well through this downturn. In fact, Origin out of Chicago, one of the biggest multifamily firms in the country, they have a proprietary software called Multilytics. It analyzes rental rates into the future using AI. It's usually really, really good. It predicted the downturn even before the downturn happened. Anyways, their forecast for the next 12 months is that rents are going to go up. This is going to be one of the biggest rent growth years that we've seen in the last few years. So looking at stuff like that, I think multifamily is where you rest your head, sleeping very, very well at night. I think multifamily is a spot. And I'm not just saying that, like I literally put my money there, and I know that you do too, Steve.
Yeah, so I want to draw a clear distinction. When we're talking about commercial real estate, a lot of these properties that are going to be bank owned or have problems are either office space, or they were short-term bridge loans that now they have to get rid of because they literally can't refinance out. that could lead to great deals. Is there anything that they should look at if they're talking to a syndicator, if they're talking to somebody about doing a deal with them? Is there a question that they should ask to make sure that they're not buying into something that could land in the bank's pile?
Yeah, great question. So number one, make sure that whoever they're working with, whoever, like if you're considering a syndication deal right now, make sure that whoever's running it has lived through a down cycle, meaning, economic recession, things were kind of doom and gloom for a period of time. Work with someone that's lived through that, because they'll know what to do. They'll know the levers to pull. We are in a very different economic climate today than we were 5 years ago, evidenced by insurance rates that are skyrocketing. Cost of goods because of inflation have gone up. Cost of labor has gone up. You've got to be a good operator right now. And the good ones, they're going to shine during this era. I have no doubt that what we're doing on our side, we're going to shine. This is actually, I don't wish harm on anybody. Steve, you know that. It's your philosophy too. But during an era like this is where we tend to shine. And so anyone that you're interviewing for projects right now, make sure that they know how to operate during a down cycle.
That is great advice. Guys, if you want to see what our latest offering is, you can go to homeinvest.com. That will show you our latest offering. Right now, the current offering is 166 unit building in Lexington, Kentucky that we like quite a bit. It's 95% plus occupied, has great cash flow, paying up to a 6%. Paying a 6% preferred and up to a 17% IRR, 1.7x multiple. You can check that out at homeinvest.com or click the link in the show notes. Nate, is there anything else that we need to cover about? I mean, we've been saying that we were hitting the tipping point for a while. I think the numbers are definitely showing that is true. Anything else that we need to cover around this?
Yeah, very last thing is that when you hear doom and gloom like this, like I hate having to break doom and gloom news, but the reality is that when doom and gloom happen, this is where good deals come out. This is where sometimes sellers get a little bit nervous and they'll just liquidate. Like we're working a deal right now that the only reason, the deal that Steve just mentioned, the only reason we got this thing, like we smoked the purchase price. It's an unbelievable deal. The only reason we got it is because the seller's financing was expiring. And so don't be nervous. Don't be scared. Just get with the right people, evaluate the deal really closely, and then you can make a lot of extra money that you wouldn't have during a time like this.
All right, guys. Till next time, be great stewards of what God has given you, and we'll see you here on Purpose Driven Passive Profits.